Good day, investors. In this video, we will be taking a closer look at ServiceNow, ticker symbol NOW. The company just released its first quarter earnings, and overall, I would say it was a strong report. However, the market reaction was quite negative, with the stock falling despite solid results, which raises an important question. What exactly is going on here? So in this video, we will break down the latest earnings report and fundamentals, then take a look at the current valuation, and finally, I will give you my personal take on whether ServiceNow is a good investment opportunity right now. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. Thank you very much. So let's start with the key financial highlights from the quarter. Subscription revenue came in at $3.67 billion, growing 22% year over year, or about 19% in constant currency, which is still very strong for a company of this size. Looking at forward demand, current remaining performance obligations, or CRPO, reached $12.6 billion, growing over 22%, while total RPO came in at $27.7 billion, up 25%. And that's important because these metrics give us visibility into future revenue, and clearly demand remains very strong. On the profitability side, ServiceNow delivered a 32% operating margin, which is excellent, especially for a company still growing above 20%. And free cash flow margin came in at 44%, which is still very strong, although slightly down compared to last year. So overall, this was a very solid quarter, with strong growth and very strong cash flow generation. Now moving on from the quarter itself, let's take a look at the guidance, because this is really what the market focuses on. Starting with Q2, ServiceNow expects subscription revenue between $3.81 and $3.82 billion, which implies about 21% to 21.5% growth in constant currency. At the same time, CRPO growth is expected to be around 19.5%, which still points to solid forward demand, although slightly lower than what we saw in Q1. Operating margin for Q2 is expected to come in at 26.5%, which is lower sequentially, mainly due to investments and the impact from recent acquisitions. Now looking at the full year 2026 guidance, ServiceNow raised its subscription revenue outlook to between $15.7 and $15.8 billion, which implies about 20.5% to 21% growth in constant currency. On the profitability side, the company expects an operating margin of around 31.5% and a free cash flow margin of about 35%. So margins are still very strong, but we are seeing a bit of pressure in the near term, mainly due to integration costs and continued investment in AI. Now, another important point to look at is how the company performed relative to its previous guidance. If we look at Q1, ServiceNow actually came in above its prior guidance, with subscription revenue reaching about $3.67 billion, slightly ahead of expectations. And you can also see that growth came in at around 22%, compared to roughly 21.5% previously guided, so clearly a solid beat. Now looking at the full year outlook, the company has also raised its guidance, with the midpoint moving from around $15.55 billion to about $15.75 billion. And growth expectations increased from roughly 20.5% to around 22.5% on a reported basis, which again shows improving momentum. Now, if we look at subscription revenue growth year over year, we can see that growth has come down slightly compared to last year, where it was closer to the mid-20% range. Today, growth is more in the 20% to 22% range, so there is some moderation. But at the same time, growth has remained very stable over the past few quarters, without any major decline. So overall, growth is slightly lower than last year, but it remains very stable and still at a strong level. Now if we take a look at remaining performance obligations, or RPO. Total RPO increased through 2025, reaching around $28.2 billion in Q4, but then declined slightly to about $27.7 billion in Q1. So there is a quarter-over-quarter decline, which is worth noting. Looking at current RPO, or CRPO, That also came down slightly from about $12.85 billion in Q4 to around $12.64 billion in Q1. However, on a year-over-year basis, CRPO is still growing at around 21%. So overall, there was a sequential decline from Q4 to Q1, while year-over-year growth remains solid. Now, if we look at customer expansion, the number of customers with over $5 million in annual contract value has steadily increased, reaching around 630 in Q1, up from about 516 a year ago. So we are clearly seeing continued growth in large enterprise customers over time. At the same time, the average contract value per customer has also gradually increased, now at around $14.9 million, which suggests that existing customers are spending more over time, not just adding new ones. So overall, customer relationships continue to expand, both in terms of scale and value. Now, if we take a look at margins, from Q4 25 to Q1 26, subscription gross margin declined slightly, from about 82.5% to 81.5%. And total gross margin also moved down from around 80.5% to 79.5%. So there is a clear sequential decline quarter over quarter. Looking at the full year comparison, subscription gross margin declined from about 85% in fiscal year 24 to 83.5% in fiscal year 25. And total gross margin also came down from around 82.5% to 81%. So overall, margins remain high, but we are seeing a consistent downward trend both sequentially and year over year. Now, if we take a look at profitability, non-GAAP net income has been relatively stable over the past few quarters, coming in at around $1 billion in Q1. There are some fluctuations quarter to quarter, but overall the trend is fairly consistent. Looking at earnings per share, or EPS, that came in at around 97 cents in Q1, also showing a similar pattern of steady but not rapidly accelerating growth. On a full year basis, both net income and EPS increased from fiscal year 24 to fiscal year 25, showing overall growth over time. So overall, profitability is stable and growing gradually, but without a clear acceleration in the near term. So after looking at the earnings and fundamentals, let's now move on to the valuation and what analysts are expecting. According to analyst estimates from stock analysis data, ServiceNow currently has a consensus rating of strong buy, based on coverage from over 30 analysts. The average price target is around $193, which implies some upside from current levels. However, if we look closer, there is a very wide range of estimates. The lowest price target is around $85, indicating limited upside, while the highest goes all the way up to about $1,160, which implies a massive potential upside of over 1,280% from current levels. The median estimate is also lower than the average, at around $150, which suggests expectations are somewhat mixed. So overall, while analysts remain generally bullish, the wide range of price targets shows there are very different views on how much growth the company can deliver going forward. Now, if we take a look at the stock performance, we can see the price action more clearly. ServiceNow is currently trading at around $84 per share, giving it a market cap of roughly $87 billion. Over the past 5 years, the stock is actually down around 20%, which is quite surprising given the company's revenue is still growing steadily. Looking at valuation, the stock is trading at a PE ratio of around 50, with a forward PE closer to 19, which suggests expectations for continued earnings growth. At the same time, the stock is trading close to its 52-week low, indicating it is currently at a lower valuation compared to previous levels. The stock has pulled back significantly, while the business itself continues to grow, making the current setup quite interesting from a valuation perspective. So when we bring everything together, ServiceNow delivered a very strong quarter overall, with a clear beat across revenue, margins, and cash flow, while also raising full-year guidance. The core business remains very healthy, with around 20% growth, high retention, and strong expansion within large enterprise customers. At the same time, one of the biggest takeaways is that AI demand now looks real, not just a narrative, with clear signs of monetization and increasing deal sizes. And strategically, ServiceNow is positioning itself as the workflow and governance layer for enterprise AI, rather than competing directly with model providers, which could be a very strong long-term position. However, some investors are still looking for faster visible acceleration, especially given how high expectations are around AI. And near term, we are seeing some margin pressure and reliance on acquisitions to support growth. So in my opinion, this was a strong earnings report, and fundamentally, the business looks very solid. ServiceNow does not look like a company being disrupted by AI. In fact, it may be one of the better positioned companies to monetize AI adoption within the enterprise. But going forward, the key will be execution, whether the company can translate this AI momentum into sustained, faster growth over time. So right now, I see this stock pullback as a very attractive buying opportunity, especially for long-term investors, because you are getting a high-quality, market-leading software company with strong fundamentals and growing AI exposure at a much more reasonable valuation than before. And if ServiceNow can continue to execute and AI adoption keeps accelerating, there is clearly meaningful upside potential over the long term. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching and happy investing.